So the good news is there's not just one way to finance an investment property. The bad news is that you have options and it takes a little while to figure out the one way that's best for you. But the options are everything from a traditional loan to creative lending strategies that fit your unique situation. Hi, I'm Jonna. I'm a real estate investor, entrepreneur, and mom who built long-term wealth through real estate, all while my husband and I balance full careers and family life. If you're earning a good income, saving for retirement, and doing all the right things, but still feel like your money isn't creating the freedom or security you want, and you want a great life, you're in the right place. Let's get started. Hey everyone, welcome back to Real Estate Investing for Life. I'm Jonna, and today we're going to dive into a question that really is a great follow-up from last week's show. If you listened last week, please refer to that. If you didn't listen, I might suggest you pop over there and listen to last week's show where we talked about how much money is needed for your down payment. Today, we're going to talk about the rest of the funding, which comes from a loan. And so the question is, what financing options are best for first-time real estate investors? There are so many different ways to go about this, and we're going to keep this super simple and straightforward today because I don't want to get too much in the weeds. Once you have this initial information, you're going to want to be able to pop over and have some great conversations with your lending partners, okay? So if you've been thinking about buying your first rental property, you've probably realized that there's a lot of different loan types, terms, and strategies out there, and it can be overwhelming to figure out which one is right for you. There's a high likelihood you already own your primary house, and just figuring out that and who the best lender was and what the best rates were and how to put all that together was enough, right? And sometimes it can seem even amplified when you're looking for an investment property because there's a lot of paperwork and detailed information that you're going to need to address to make sure that you can fully take care of this new baby property on top of your current mortgage. If you're renting, it's a little bit different scenario, but a lot of my clients and people that I mentor are also homeowners. So it's really important to know that there is a difference. And so what we're going to do today is break down some of the most common options and what makes them different and how to decide what meets your goals. Financing is like the big hurdle, the big thing that you need to get prepared for in order to move forward. And when you're buying your first property, financing can feel like the biggest obstacle because it's also the biggest leverage point for building wealth. And that's part of what makes real estate so different than other types of investment opportunities is the power to have that leverage. It is such a great way to amplify the funds that you have available. And getting the right loan doesn't just make the purchase possible, it can literally determine whether your investment property makes sense or has any cash flow or not. So the good news is there's not just one way to finance an investment property. The bad news is that you have options and it takes a little while to figure out the one way that's best for you. But the options are everything from a traditional loan to creative lending strategies that fit your unique situation. We're going to get started with the most common type of financing first-time investors use, and that is the conventional loan. That is definitely the way that I got started with purchasing rental properties. I frankly didn't know any different, and it worked out. We were in a situation where we did have W-2 income, meaning we had a employer that showed proof of getting paid and having money get into our bank account, and we had good credit that we had worked hard to maintain. And those are the two biggest criteria for getting a conventional loan. It's a classic starting point. There is nothing wrong with it. And for most new investors, it's just a really good entry point. And it's your standard 15 or 30-year fixed mortgage through a bank, a credit union, or a broker type lender. And I say 15 or 30, that's a whole nother conversation of which one makes sense. We've done a mix throughout the years of our investment properties, which there's pros and cons to. And if I had to pick one standard answer, I would probably say in most instances, opting to the 30-year fixed mortgage gives you the most flexibility possible if you're a little bit tight on your cash flow or your finances and you don't want to be stressed with that higher monthly payment when your property sits vacant. But if it's just like teeny drop in the bucket for you to get this property, and you're going to be fine if you have a little bit of negative cash flow from time to time, feel free to entertain a standard 15. It's kind of that idea of having everything paid off by a certain age, right? And you can always refinance later, but most people tend to elect towards a 30-year mortgage. You'll typically need 20 to 25% down payment for a non-owner occupied property. We talked about that on the last episode. You can refer back to that. And I talked about good credit. Your credit score usually needs to be at least 680, 700 or higher is really the best case scenario for getting the best rates. And the interest rate will be slightly higher than the one you'd pay on a primary home loan because lenders view rentals as higher risk. And I've seen that anywhere from 0.5% to 1% higher. Again, check with your local lender. This option of a conventional loan works great if you've saved up for a strong down payment and want stable, predictable payments over time. With a fixed rate, you know exactly what your payment's going to be. The beauty is, of course, the payment you have in 2026 is going to be the same payment you have in 2046. And at that time, you better have positive cash flow. It's ideal for buy and hold investors who plan to rent their property long-term and value consistency. And that's really the way that I've gone with most of my properties. There's a few exceptions, but it's hard to go wrong with that option. But what about if you don't have a large down payment yet? One of the smartest entry points in real estate is house hacking. We talked about that just a teeny bit last episode, but house hacking means you buy a property, either a single family or with up to 4 units, live in one unit or live in one bedroom and rent out the others. It works because this is the power of it. You can qualify for that FHA, VA, or conventional owner-occupied loan. But the difference is with a conventional loan, you could lock in a conventional loan for as low as 5% down, which allows a lot more flexibility. Sometimes you're at 3.5% down for FHA or 0 with a VA. And the beauty of that is, of course, you don't have to wait so long to have that down payment. The negative, of course, is you're going to have a little bit higher payment because you just frankly have a bigger mortgage or loan amount on the property. You'll get better interest rates because you're living in the property if you do that. And there's some qualifiers. You're going to need to live in the property for a certain number of time. Your lender will fill you in on all that information. But one of my most successful rental properties was actually one that we lived in, had put very low money down in, lived in, enjoyed, and then moved on. And today it's a rental property. So I highly recommend this option if you have flexibility, if you're currently looking for a place to live anyway, even if you're not going to rent it out right away, but you're going to just commit to live there on your own for a year or two, whatever the parameters are from the lender, and then turn it into a rental. That is such a great option as well. FHA loans are so popular for this reason, but keep in mind you must live there for a certain amount of time to meet the requirements. If you're looking for a practical way to build your first investment while keeping costs low, I really believe this is one of the most proven paths to get started. Now, if you're ready to invest in a property you won't live in from the get-go, but don't want to be limited by your personal income or debt-to-income ratio, you might want to explore what's called a DSCR loan. DSCR stands for Debt Service Coverage Ratio. Instead of qualifying based on your W-2 income, lenders look at the property's cash flow. In other words, can the rent cover the mortgage and expenses? These loans are amazing for investors who have strong credit and some capital but may not show high taxable income on paper. They're popular for short-term rentals, long-term rentals, and even small multifamily properties. If you want to learn more about DSCR, bridge loans, and other kind of creative financing options, I'd encourage you to go back and listen to an episode I did earlier this year with Patrick Penner. He is a primary DSCR lender. It's episode 18, but it's really packed with practical advice for investors in today's lending environment. Okay, we covered conventional, we covered moving in and getting an FHA or VA type of loan, and then DSCR loans. But there's other creative, non-traditional ways that people fund their first deals. I'm just going to touch on a couple of these. One is a partnership. And an example of how that might work is you bring the deal or the management experience and your partner brings the cash. This approach lets you get started even if you don't have all the funds yourself and make sure every agreement is clear and in writing. I've even seen this at work and be successful if it's a realtor that brings a deal to a client or a real estate customer and they're able to work out something where the realtor has some equity in the property. That's a whole nother conversation, but realtors are so uniquely positioned to get their foot in the door and to get some real estate equity in their lives. And it's really sad how few do. So I think I need to do an episode about that. The second non-traditional way that people fund their first deals is private or hard money loans. And these are really short-term loans. So they're not the long-term solution you want for the next 30 years, but they're often used for fix and flip projects or properties that need repairs before a traditional lender would finance them. I've seen coaching clients and real estate clients utilize this method, and sometimes there's an opportunity that comes up that is off market and it needs to get closed quickly, and there's no time for conventional financing, and sometimes the property is not in the shape to be able to qualify for some of that conventional financing. So this is where private and hard money loans come in. Private money is more of a kind of a boutique kind of situation where a private money lender creates a scenario where they have terms that they provide the money to the end buyer. Hard money, very, very similar. Sometimes the two words are used interchangeably, but hard money sometimes lends itself to more of an institution or a company that's funding those loans. And sometimes the rates vary a little bit and they can be a little bit higher too. But again, every lender is individual. They're faster, they're more flexible, and hard money and private money comes with higher interest rates and shorter terms. So the caveat with this is you need a clear exit plan. If you use these responsibilities, they can open doors to deals you couldn't do otherwise, but they're not for everyone. Another example is if you're buying that property that needs work, you're planning to buy and hold, you could close the property with a private or hard money loan and then refinance it into more of a conventional loan product or a DSCR after the property is fixed up and is rented, and you can look at what that property is getting for rent. Something that's used really quite often, especially with more experienced investors. And I love that we have options, and this is why it's important to get relationships in place with these different types of lenders before the property appears, so you have options. Maybe you're all lined out with a traditional conventional loan approval, but this property pops up that you need to get closed on in a week, and that conventional loan's not an option. So there's beauty and there's power and negotiation power in knowing that you have different options for what might work best for the seller, which is really cool. That really outlines some of the main types of loans, but so the question really becomes, what's the best financing option for you as a first-time investor? The answer depends on your situation and your goals. Here's 3 questions that I would ask myself. 1, how much money do I have for a down payment? 2, how do I plan to live in the property? Do I plan to live in it at all, or do I plan to rent it out completely? 3, is my credit strong enough for conventional lending, or should I explore a DSCR or partnerships right out of the gate? Your first deal truly sets the tone for how you'll invest moving forward, including how much in funds you're going to tie up for that first deal. So it's worth taking time to explore all your options and get the right fit. And remember, you don't have to figure this out alone. This is where you start now, creating those relationships with an experienced mortgage strategist, an experienced private or hard money lender, some people that understand investor loans specifically. I wouldn't just go down to your local bank and just ask them what their run-of-the-mill products are. I would really make sure that you're talking to someone that's experienced in investor loans, and you're going to be in a great position. So to recap, conventional loans are absolutely fantastic for long-term buy and hold investors. House hacking and owner-occupied loans can get you started with less money down. They're a great solution for that kind of situation. DSCR loans and creative financing options open the door for experienced and self-employed investors. That's huge. So if you're self-employed, you definitely want to look into that. And partnerships or private money or hard money can bridge the gap when you find the right deal. The key is really to match your financing with your strategies and your goals. And if you haven't yet, make sure to listen to that conversation with Patrick Penner back on episode 18, where we dive into some of these creative financing DSCR paths. Thank you so much for listening. And I am here as a resource. If there is a topic related to investing that you haven't heard me talk about that you really want to drill down on, please reach out to me. You can find me over at jonnaweber.com, and I'm here to help. I'm your trusted, big sister here, helping you build wealth and a life you love through the power of real estate. Go and grow, guys. We'll see you on the next episode.